Hello and welcome to this weekly market recap for the week ending Thursday, Thursday, October 3rd, 2024. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it is a pleasure to join you once again this week. I'm going to jump right in. I do want to mention that we've got a big jobs report coming up tomorrow on Friday. That could send the market obviously going one way or the other. I think so far the market's been holding up really well, because we have rates coming back down and no real signs of economic weakness yet. So what I think we really need to focus on is that big jobs number coming out on Friday. But let's take a look at what's happened over the last week. So I'm going to start off like I usually do with the 17 key indices and sectors. And I've got this set to 1 week so that we can take a look at exactly how the week has unfolded. You can see energy, clearly the leader over the last week. We've seen crude oil prices jump as the Middle East crisis, reignites again between Iran and Israel. And as a result, we see the energy shares, the XLE up 4.08% for the week, easily topping all the other indices and sectors. And if we go to the bottom, you will see that technology was the laggard again last week. Again, going from the close on Wednesday of last week to the close on Wednesday of this week. So just want to be sure that, we're talking about the same days. But technology having a rough week, dropping 1%. You can see as we look at all the major indices and the sectors, it was really a bifurcated week. Some areas saw strength. I mentioned energy, utilities, communication services, also industrials and financials. So it kind of reeks of value stocks, dividend payers, as opposed to the more aggressive stocks that we find in technology, which is down near the bottom. Consumer discretionary, also down near the bottom. That's another fairly aggressive group. And consumer staples down there as well. So a lot of the consumer stocks really didn't participate in any of the movement to the upside over the last week. Moving on to the S&P 500. We did break out above the double top. That was a little bit earlier in the month of September. Back in mid-September, we broke out above the high in July and also in August. We since pulled back and actually on Wednesday did come back down and test the 20-day moving average before bouncing and finishing back closer to the high of the day. So all in all, considering we were down earlier, it didn't turn out to be as bad a day as it maybe could have been. And I think short term, as long as the S&P can continue to trade up above that rising 20-day moving average, then I think all is well. If we go down below the 20-day moving average, there is a gap support level right here at about 56.20 or so, maybe just a little bit below that level. I think it might be around 56.15. But if we can't hold the 20-day, that would be the next key area of short-term support. The Nasdaq 100, on a relative basis, maybe not doing as well as the S&P, because the S&P, like I said, we did move up in the second half of September, put in all-time highs. We have not seen that yet on the Nasdaq. The Nasdaq high from back in July, still holding as the all-time high. We have broken above the 20-day moving average, is broken above the 50-day. So we do have a recent golden cross, which is a bullish signal. We did break out above the high that we saw in August, which was a good signal as well. We've pulled back. We did bounce off the 20-day on Wednesday on the Nasdaq, similar to the S&P 500. So that's all good news. And again, trying to hold on to this gap support zone. But if the Nasdaq 100 loses its 20-day moving average, just like the S&P 500, we've got gap support that we'll be looking at probably down around the 19.3 area. Moving on to the IWM, this is a small cap index. Small caps, we got multiple tops still up near the 225 level. That's the key resistance to watch. To the downside, we've got a couple of key lows. We have the low from the second week of September, which is down closer to about 204, 205. And then, of course, the big gap down from back on August 5th. And that was after we had the Fed meeting at the end of July. Had a couple of big down gaps on small caps. That low was down at around the 197 level. And you can see that came in almost exactly where the lows were back in June. So if things were to really get rough at some point in October, we could see that August low. But I'd be watching probably a little bit closer maybe the low earlier in September. And of course, the moving averages, I would continue to watch those as well. So I believe we're going higher into year end, but October can be somewhat of a volatile month. I actually have an interesting stat. If we look at October from the 1st to the 27th and just combine all 27 days, the annualized return of October through the 27th is just about 2%. So in other words, it's less than what we normally see on the S&P 500 every year, which is roughly a 9% return. So October 1st to the 27th tends to be a little less than average. And we've also got our presidential election coming up at the beginning of November, and October tends to be weaker in years when we have the presidential election. So we still got some things to worry about here in October. The good news is, though, that October 28th to the 31st, and actually the bullish period extends beyond that, but from the 28th to the 31st of October, the annualized return is over 70% on the S&P 500, which is about 8 times the normal average of 9% a year on the S&P. So we do have some good things to look forward to historically, but we've got to get through the rest of this month of October in order to get there. Early November tends to be strong. And I will say, from all of my research, the absolute best time to be invested in the stock market is from the close on October 27th through the close on January 18th. So we're getting closer and closer. We're only about 3.5 weeks away from the strongest historical period of the year. And we're winding down the summertime into early fall when the market tends to struggle the most. So we do have that historical bullish tendency ahead. I'm looking forward to getting there. I think this year probably will be no different than many others. And I think we go higher later in the fourth quarter. Energy, I mentioned energy leading last week, so I thought I'd pull this chart up. 91 has been an area since we had the big drop back at the end of July, early August. We've been struggling when we get up to this 91 level. We did it in mid-August. We did it again in late August. Tried to get up there one more final time right toward the very end of August. Got up to 90 maybe 2 weeks ago. And then on Wednesday, we hit 91 and we failed. So we're still trying to get through this 90-91 area. I think if we get through, next level would be the triple top up around 93.5. So we still have some potential upside in the XLE, but we do need to negotiate $91 on a close first. You can see, though, the last 5 charts or last 5 candlesticks on this chart, after gapping down last Thursday, you can see we've had a really nice recovery, getting back up above recent highs. And again, like I said, testing that key 91 level. So energy, strong volume, nice recovery. Check out the PPO, which has now turned positive. We did see that one other time in the second half of July before rolling back over again. So we're certainly not out of the woods, but the strength we saw in energy last week has certainly helped pick up maybe some interest in this group. And again, with that heavy volume accompanying it, that's not a bad thing. All right, I want to talk a little bit about seasonality here because now we've moved into the fourth quarter. And clearly for me, there are 2 groups that love the fourth quarter. One is, we're going to get into the transports. I'll pull that up in just a minute. But the first one I wanted to mention is the XLF. Don't need the dollar sign there. XLF relative to the S&P 500. So what we're going to be looking at here is how financials perform relative to the S&P 500. And I'm going to go back to 2013, which is when, in my opinion, this secular bull market began. It was April of 2013 when the S&P 500 cleared the 2000 and 2007 highs on the S&P 500. So that's when we got the breakout. In my mind, that's when we had the confirmation of a new secular bull market. So over the last 12 years, I just want you to look over here and check out the relative strength of financials starting in September. If you add across here, we have 0.5% outperformance in September, 0.9 in October, 2% in November, and another 0.5 in December. Those are average outperformance numbers for each of those calendar months. So if we add them across, that's 3.9%. And I think the others, let me see, I think I had jotted that down. Yeah, all of the other 8 months was minus 2.6% relative to the S&P 500. Now, if we do the same thing with the industrials, we'll see not quite as bullish action, but still pretty bullish action. Going back over the last 12 years again, September, October, November, and December, if we add across, that is 2.8% outperformance versus the S&P. And if we look at the other 8 months from, or actually, the other 8 months, I came up with minus 1.3%. So industrials tend to underperform throughout the year until you get to September. And then once we get to September, we tend to see the best quarter of the year for both financials and industrials. The last one I'll mention here, the transports. And on the transports, you can see if I pull this back, I'm going to go back 16 years. There's 14, 15, 16. Look at November. November loves, or transports love the month of November, where we've seen outperformance by almost 2 percentage points for the last 16 years. But again, if you just look at September, October, and November over the last 16 years, transports have outperformed by roughly, well, by an average of 3%, outperformed the S&P by an average of about 3% per year for the last 16 years. That's pretty strong action. These bars tell us the percentage of these months where the transports have outperformed the S&P. So you can see these 3 months, especially September and November, these were the best, have been the best 2 months of the year. If you look back earlier in the year, you can see it just doesn't happen nearly as often. Most of these months carry negative relative performance. So transports typically underperform the rest of the year. So we have 3% on transports for those 3 months. And then the other months, minus 4.1. So if we go from December to August, transports underperform during that entire period by roughly 4.1 percentage points versus the S&P 500. But all of a sudden, September, October, and November, we see strength. So with that, I wanted to just show you quickly the transport chart. And you can see we have been strengthening in September since the first week. And the question is, can we break through? Now, if we're going to break through this key resistance area, it seems to me like it probably will happen in October or November, since this is the seasonal period when we do typically see strong action in the transports. So that's something I think we can be watching, the next couple of days, next week, and really for the next couple of months. But historically, this is a group that does tend to perform well in October and November. So keep that in mind. I also want to talk a little bit about an event that we have coming up this week. If you go to EarningsBeats.com, toward the top of our homepage, you'll see a link where you can register for an event that's coming up this weekend. Normally, these market vision events where I talk about the upcoming, normally the market vision events beginning of the year, and I give you my opinion of what's going to transpire throughout the year. We're beginning to do these now quarterly. So these are what I would consider maybe little mini market vision events. But I'm going to go through, kind of summarize everything I'm seeing in the market, what I think we're going to see in the fourth quarter. And normally these events are reserved for our annual members over at EarningsBeats. But this first quarterly edition, we are going to allow anyone who is a trial subscriber and up to participate in this event. So if you want to check it out, it's going to be Saturday morning at 10 a.m. You can click on this button to register. You will need credit card to sign up, become a 30-day trial member, but we will let you know when your credit card or when your 30-day period is about to expire, and make sure that if you're not comfortable with our service, you don't want it for whatever reason, we'll make sure you get canceled and you're not charged. If you're on a mobile device, you can go and click on or scan the QR code that is on your screen, and that too will take you to the landing page where you can get signed up. But it's going to be a big event. It'll be a packed house, and we'd love to have you there. Saturday, October 5th, 10 a.m. Eastern is when the event starts. And they're also, if you can't make it, it's no big deal. We'll have a recording, and the recording will be sent to all of our members, including our trial members. So even if you can't be there live, you still get a copy of the recording. So make sure you check that out. All right. To wrap up, I want to go through some individual stocks that aren't your typical stocks. I mean, I'm not talking about Microsoft or Nvidia or Apple or Meta, even though I think Meta looks pretty good right now. Tesla, Google, Amazon. I'm not going through those. I'm going to give you some stocks in some other areas of the market that I think are showing tremendous relative strength, breaking out the all-time highs. You don't have to just trade technology names or the big, the Magnificent Seven. There are plenty of stocks out there with the rotation we've been seeing. There are plenty of stocks where you can find very strong bullish momentum. Maybe we get a little bit of a pullback. These are some stocks you might want to take a look at. So I'm going to start off with Aflac AFL. You can see, first of all, many of these stocks, you're going to see strong AD lines, which to me is indicative of accumulation. You're going to see relative strength of many of these stocks versus their peers that are strong, either at 52-week highs or close to 52-week highs, or maybe just really starting to improve. And many of these will also be in groups that are showing some relative strength. So Aflac is a perfect example. We did get a recent breakout here after going sideways for a few weeks. We made the breakout. I think any kind of a pullback to that 20-day moving average around 110 would be an interesting entry level into AFL. Another stock in this same space, life insurance, the Unum Group. And recently we just got a breakout here. Also, AD line just broke out. Relative strength has been we were going up for several months, pulled back in August, and now we're starting to strengthen again. And the overall group life insurance is coming off the low from back in early July. That was the time when we got the June CPI, core CPI, which had fallen considerably. And as a result, we started to see a lot of money rotate with Wall Street expecting the Fed to begin cutting rates. And of course, recently, that's exactly what they did. They cut rates. So many of the financials, industrials, and so forth are companies that tend to do well this time of the year. And I think also will do well if rates drop, because I think the market will begin to start pricing in future economic strength, even more so than what we have currently. So that's UNM, again, breaking out above about $58. Pull back to that level, or maybe the 20-day. Again, that's an area where I would be focused. Moving on to the industrials. This is Jacob Solutions. This is in the heavy construction area. Look at the triple top that came across here at about 127, 127 and a half. We made that breakout. We've run to 135. Volume trend's nice. You can see the AD line posting a new high. Relative strength was weak, but we're just now starting to see that pick up, with volume picking up as well. So this is one that maybe hasn't been showing as much strength, but a pullback back to maybe the 20-day moving average or close, I think could set this up for a really nice reward to risk trade. Next up, AM. This is in the energy space, integrated oil and gas. You can see again, strong AD line. This is one of the best performing stocks in its peer group, but you can see the peer group here. Many of the energy groups other than pipelines has been weak. But this, even though we've been in a weak market for many energy stocks, AM is actually breaking out to a new 52-week high. Just broke out with some moderate volume. This one looks to me like it could run from here. Another one, LYV. This is Live Nation. This is in the broadcasting and entertainment area of the market. So it's in the communication services sector. But another one that has been absolutely on fire. Volume picking up. You can see the AD line moving straight higher. Relative strength is awesome. This is another one. Keep on your watch list. You get a pullback. Seem like this would be a nice entry. Maybe again down close to that 20-day moving average. Home Depot. Home Depot. I mean, you can see again AD line nice. It's in the home improvement area, which has been improving versus the S&P 500. We did make a breakout here on HD above that March high. And again, just waiting for a pullback here. Another one that looks really strong. RTX. This is Raytheon Technologies in the aerospace area. Again, sound like a broken record, but AD line, new high, price breaking out above prior highs. Again, maybe a little bit of a pullback would be better. Relative strength has been strong really since all the way back in December of 2023. And the overall group, aerospace, not far from breaking out to a 52-week high. And again, this is in the industrial area, which loves this time of year. So with the historical tailwinds and some of the relative strength and the signs of accumulation, these are some stocks that I would be interested in. Last one, another industrial, is Leidos Holdings. AD line, again, strong. Relative strength, we took about a 2 or 3 week drop, but it is starting to pick back up again. The overall group is pretty strong, probably getting close now to about an 11-month relative high, and that is in the defense area. But again, another one that's broken out. Anything back down near the 20-day moving average certainly would appear to be pretty good, solid entry area. All right, so that's it for me. Again, we've got the big jobs report coming up on Friday, tomorrow, so you want to be careful there. I could see a big response if we come out with a solid jobs report. I could also, knowing how volatile October can be, if the number comes in below expectations, you could start hearing more and more chatter about a possible recession, which could, in fact, lead to some selling ahead of the election. In order to follow me at earningsbeats.com, you can use your mobile device and you can scan the QR code on your screen now. Go to a landing page where you'll find all the various places where you can find me. Make sure you click the like button and subscribe to the Stockcharts YouTube channel. They would appreciate it. I would appreciate it. And really appreciate you all coming in and checking out today's video. Have a great week ahead, and I'll see you next Thursday. Happy trading.